Good morning, everybody. Welcome to our third of our Mindset Meets Mechanics webinars. The title of this particular session is Getting Started with SPA3 Investors. So I'd like to thank everybody for taking a little bit of time out of their days to join me on this particular session. And those of you that are watching later on, thank you for investing the time in this particular session as well. So what are we going to be talking about today? We'll have a quick recap on the first session that we did, which was portfolio considerations. We'll have a quick recap of the skills acquisition plan, and then we'll get into the meat of it. So getting started with Beyond Chart. So we'll have a look at some basic navigation for Beyond Chart, just getting around, a few little hints and tips. We'll then go and have a look at the portfolio manager, why we need to use the portfolio manager and its relevance, how to set up a new portfolio, the 25 trades exercise. So what sort of things can we be jotting down as part of the 25 trades exercise? And what's the point of doing the 25 trades exercise? And is it actually 25 trades, or is it more, or is it less? Also demonstrate just quickly how you can sync the app. Also have a look at how you can also import the public portfolio and take a look at those, the journey of any of those public portfolios that you have a subscription for. So that is your data subscription for. Have a look at the statistics, etc., and see what we can make out of those as an example of just one particular journey in each of the relevant markets. All right, so before we do that, I do need to discuss our disclaimer, and that is that the content of today's session is purely for educational purposes, not to be construed as financial advice. It's very much general in nature. We don't know your individual circumstances or particular needs. I think everybody understands that. All right, so let's get underway now. Don't forget, at the end of the session, we will have a Q&A. So if you do have any questions, please feel free to type those in at as we near the end. All right, so stage one, the first webinar that we looked at was portfolio consideration. So we were thinking about the three investing stages that we go through as part of our investing lifespan. And the first stage is basically from 18 through to around about 55 years of age. And the biggest problem that we discussed at that time is not growing your capital sufficiently to allow for a comfortable retirement. And if you spend any time on the ASFA recommendations of how much capital you need for a comfortable retirement, it's not a big figure. And I wonder how quickly that those funds might actually run out if you're wanting to live a lifestyle like you are whilst you are currently working, or do you actually want to do more and do lots of travel, etc. So certainly a big risk is not acquiring enough capital. So we talked about some of the suitable strategies that you could use, very simple ones, the benefits of compounding, adding contributions over a period of time, and making sure that it's easy to do. One of the biggest risks, obviously, in using some of those buy and hold types of strategies is that it becomes riskier towards the end of stage one. And why is that? That's because of sequence of returns risk. So in stage two, this is the biggest risk, the sequence of returns risk. And as a result, what we try and do is to lessen the impact of sequence of returns risk. So remembering, sequence of returns risk is just when a large bear market occurs in your investing lifespan. If it occurs just as you're about to retire, a la 2008 GFC, then it's really going to knock the wind out of your sails, and it's going to make the future quite difficult, given that it can take, on average, up to 6 years for the market to return to its former highs. So if you need to draw upon your capital during that time, that's going to be problematic. So hence the idea of using timing to protect as little or as much of your portfolio as you desire. Now, obviously, with the use of timing, we get the benefit of avoiding large market declines like in the GFC, 2008, 90, 87, etc. But it does require a higher level of skill set. So when we're talking about skill set, it's really about mindset. So whether we start to use timing in stage 2 or 3, it really doesn't matter. The main thing that we need to learn is how to control or how to acquire those specific mindsets that are going to enable us to sail in all weather conditions. So that is, invest in all market conditions. So we're still looking for growth, but we still need to be mindful when we're in retirement, as an example, of longevity risk. So what happens if you outlive your capital, which hopefully everyone has a long, healthy lifespan. And that would be problematic as well. If you happen to outlive your capital and you're still healthy and happy and you've still got plenty of time, then not having sufficient capital is going to be it's going to be difficult. It's going to be a real challenge. Inflation risk. We live in an environment where inflation's been very high over the last few years, coming out of a period where inflation was very low. Government pensions, are they always going to be there? And are they going to be available right through to the end? So obviously having an approach that focuses on preserving capital is really important, and also maintaining the value of that capital as well. So if we're going to take a more active approach to our investing, then as we can see, it's going to require a higher skill set. So we talked about portfolio structures. We talked about core portfolios being a large body of funds, if you like. It typically takes a fairly passive type of approach, well suited to stage 1 and potentially stage 2. And then as we're getting to stage 2 and 3, wanting to protect from sequence of returns risk, but still maintain the value of our capital, keeping ahead of inflation. Therefore, we still need to invest. And if we're going to invest, watching out for sequence of returns risk, hence we use timing. And so timing is a more active strategy, which has obviously the benefits just discussed, but it does require a higher skill set. So given that it requires a higher skill set, we do need to do some training. Okay, so we need to further our understanding of how our mind works, particularly in relation to the markets, because it's something that is not naturally acquired through our education. It's something that we've got to experience along the way, and our typical mindset is not well suited to the market. So we need to learn what these mindset skills are and how to acquire them. So hence the 4-week process of mindset training intensive is a great place to start. A lot of you that have come to the markets and interested in trading and investing will have read Mark Douglas's Trading in the Zone, and we've combined that with Gary's personal mentoring from Mark Douglas, and we've also integrated James Clear's work from Atomic Habits to put together that particular course. And central to that course, a very important document, is the skills acquisition plan. So this was last week's webinar, so I'll just recap on this, some really important concepts and why this is such an important document. So the skills objective component, the skills acquisition plan, this is about knowing when you've made it, okay? When you've made it and you've acquired the right mindset skills. So you'll know when you've made it when you are actively able to trade your investing strategy through multiple periods of drawdown. So the objective with the SAP, the Skills Acquisition Plan, is to be able to trade through at least 2 periods of greater than 10% drawdown. Okay, and by doing such, so going through the drawdown, continuing to execute so that your portfolio has the run-up to come out of drawdown. So doing that multiple times. And if you can do that, then that means that you are a good sailor of your sailing vessel, and that you can actually sail in all weather conditions. No matter what the wind's doing, no matter what the sea's doing, what the tide's doing, it just simply won't matter. Okay, so how do we know when we're out of drawdown? Well, that's when your portfolio achieves another all-time high. So from that point of view, how do we measure that? That's where it becomes very important to have a portfolio management tool that is going to allow you to plot your equity curve. So that's a mechanical part of the process. So placing your buy and sell trades and recording that in the portfolio manager. It's a fairly straightforward process. However, the mindset skills that you're going to be learning along the way are going to take more effort. So if we think about that, the mechanical process is really 10% of the equation, but the thinking, acquiring the mindset skills is 90% of the work. Okay, now this is where most investors place very little emphasis, and as a result, their results, they don't achieve the results that they intend to. Okay, they've set their their goals in terms of the rewards, but they haven't set their goals in terms of their skills and the mindset that they need to acquire. So 90% of the work, and as highlighted there, the 25 trades exercise is a key component of acquiring these skills, because if we don't go through a process where we raise the awareness of our current mindset, then we're not going to know whether we're developing. Okay, so if we can't monitor, then we can't measure. All right, so really important that we integrate that 25 trades exercise, and that we also use the portfolio manager to determine when we've gone through those periods of 10+% drawdown and therefore on the tail of that, the run up to get us out of the drawdown and acquiring those mindsets, developing that mindset through those choppy, turbulent times. All right, so what we're going to do now with that as a backdrop is to bring over Beyond Charts and have a look at some of these topics. So going through some basic navigation, the portfolio manager, we'll set up a new portfolio. We'll have a look at the 25 trades exercise, a quick glimpse on how to sync to the app, and also how to import the public portfolios and have a look at a few statistics, etc. All right, so I'll bring over our good friend Beyond Charts and blow that up so we've got the entire screen. So this, understanding that a number of members that are watching today are familiar with Beyond Charts, this is really just for our newer members, just to provide some basic tips. So when you first come into Beyond Charts, obviously we've got a number of tabs across the top. It's a grey environment. Don't worry, you can't do anything to Beyond Charts that's going to hurt it in any way. So please don't feel afraid of clicking and having a look around. So a number of tabs across the top. The Home tab, quite often get asked about where can I find information about some of the exits that you will get notified of in the app. So you'll notice that we have exit signals that are ATR trailing stop exits, but we also have some price action ones as well. You can read about those in the documents section. Don't forget, this is also where we have a number of other useful documents, so investment plans as an example. So the Getting Started Guide, that's a good little cheat sheet, if you like, on tips and pointers to do with getting around Beyond Charts. So don't forget that. You've also got Tutor Me, which will also provide some background information about analyses and overlays, different indicators, and so on and so forth. So I'm not going to go into all that today because it's there. And clearly we've also got the link to the Education Centre. The Chart tab, this is where again, quite often get a few questions. David, I'm using SPA3 Investor and my signals have disappeared. Well, that just means that we don't have the signals turned on, and that's done under the Chart tab. So whether you're using SPA3 Trader or Investor, exactly the same. We've got a Favorites tab as well, where you can insert a number of indicators or line studies as examples, depending on what you like to look at on your charts when you're viewing them. Now, keeping in mind that Beyond Charts is a technical analysis charting package, and from that point of view, if you're wanting to draw lines and all those sorts of things, then you can certainly do that and apply various indicators. Now, remember that when we're using a purely mechanical system, we don't need to worry about all those other forms of analysis. It becomes irrelevant. Okay, they are very much subjective. Right, the Systems tab is where we go to run our daily scans. So whether we're running an ASX scan, a US scan, a SPA3 Trader scan, ETF scan, or whatever. So that's where we do that. We've also got the market and sector risk. Now remember, that's only for SPA3 Trader. It has no impact whatsoever on SPA3 Investor. Importantly, we have a portfolio manager, and we'll spend a little bit of time going through this to set up the portfolio, have a look at some of the individual sections of this. Again, so the example might be that after you've created a portfolio that you are wanting to add some further cash. How do we go about doing that? And we also have a simulator. I'm not going to go into the simulator today, but the simulator is a really good tool for benchmarking your own execution. So you can actually set up a simulation that starts from the very first date of your portfolio with exactly the same number of positions, exactly the same capital, and run that simulator forward. So as an example, you may have started a portfolio 6 months ago and you'd like to think, how am I actually tracking against the trades that I should have taken? and you can run that simulation, and ideally it should be exactly the same as your own portfolio. So if it isn't, you can ask yourself some questions. Why isn't it? Have I made a mistake along the way? What's the source of that mistake? And try and work out, why there is a difference. And you can actually learn quite a lot from running those simulations. All right. So just a few basic Beyond charts, a little bit of housekeeping in terms of getting around. Obviously, when I first started learning about Beyond charts many, many years ago, it used to fluster me because I didn't understand very simply that these panels that pop out from the side could be pinned out. And every time I would move my cursor away, they would disappear. And I think, where on earth have they gone? And it was only after a little while that I realized, you can actually pin or dock these panels out so that they stay there. Now, it seems very obvious in hindsight, but it was something that I had to become familiar with. Now, obviously, once we've pinned out a panel, the great thing about that is then we can just toggle between each of the sub panels, if you like, and it just moves from one to the other. We don't have to worry about that panel disappearing because I've anchored it, and that's a useful thing to know how to do. And likewise, on the right-hand side, you might like to have a series of indicators that you like to apply to your chart. Well, again, if you pin the indicator panel out, it will stay there. Now, you'll notice there that the indicator panel is in grey. That just simply means that it's not active, and it's not going to be active until we have something to apply those indicators to. So naturally, they can only be applied to a chart. So to open up a chart, if I go to my industry watch lists, I can double click on a watch list, and that will open up the first candidate in that list. So as an example, ABC. Now, you won't have this in your current version of Beyond Charts. The version I'm using here at the moment is a little bit different from the one you've got. Now, obviously, this one needs to go through the upgrade because ABC is not a stock that is in the watch list any longer since it's been taken over. But if we go through AFI, that'll definitely be in your list of stocks. And I wanted to apply indicators. You'll see that the indicators, they're all now bolded so they can be applied. So whether you're wanting to apply, any variety of indicators, you can simply just go through, highlight the indicator, tick, and that applies it. Another way that you can apply any of these indicators, again, is you can drag and drop them onto a chart. So an exponential moving average, our parameters down the bottom here, we can change these to 21, 63, 125, whatever you want. You can also change the colors, etc. So rather than blue, it might be red. And then I can just simply drag it onto the chart. So just some basic how to use some of the functionality of Beyond Charts. So that's one use of the indicators. Some of the other indicators we can use in terms of charting portfolios, and that's going to be coming to become very handy as well. So we were able to do things like benchmarking a portfolio compared to the broader market. That's a good thing to do. Comparing performance of one portfolio against another. And they're things that we can all do within Beyond Charts. Some other panels across the bottom, we have line study. So if you're wanting to draw trend lines and so on and so forth, you can go through and select a trend line. And if I'm doing that as part of it, I can, in fact, the way I like to do my trend lines is if you're just drawing them from one point to another, you might also like to draw some channels. So you'll often see Gary do this. So you can right click, and that's a handy little reminder as well. When in doubt and you're on a chart, if you right click, a menu will come up and give you a number of different options. So in this case, a parallel option. So if you wanted to draw a channel as an example, that's a very simple way to do it. Now, if I want to clean the chart as an example and remove all of the additions that I've made to it, once again, when in doubt, right click, and then I can go down to the selection, clear chart, and that clears the chart for us. So very, very easy to do. A couple of other things that you might like to do from time to time is down under the analyses section. Down here, you'll see US analyses, and Gary does a lot of analyses on various different stocks and indices and commodities and so on and so forth. And you can go through and you can import all Gary's analyses. And to do that, under this little drop-down menu here. It says AWS Analyses. I won't do that now because it does take a little bit of time. I click on there, and then what that will do is it will grab all of Gary's analyses and import that down into that bottom section there. So again, just a few little hints and tips to do with getting around Beyond Charts. Some of the other useful little bits are your watch list manager, where you might like to go through and create some of your own watch lists. We have a scans panel. This is where the actual scans of Beyond Charts are controlled. So you'll see a list of different scans. All these scans are in the same order as over here on the Systems tab, and we go through the top. So you'll see there from left to right, you'll see the ASX stocks, ASX ETFs, exactly the same in the scans drop-down menu as on the right-hand side. So these scans, we have 3 tabs. We have securities and settings. So securities is just telling us what the scan's going to be looking through. So it's looking through that particular watch list. And then the settings is what is it looking for? It's looking for entries and exits. And it's doing that over the last 5 days. So they're exactly the same settings that are being used in the Shareholder Systems mobile alert app. Okay, so that runs on a Amazon web server at nighttime, and at the end of the day, when all the data's through, it runs over to Beyond Charts. It's running on that server, runs the scans, and that information is fed through to the app, and you get a little notification at nighttime. Okay, so that's how the app works with Beyond Charts and the notifications. All right, so what we might do just before closing up there is one other thing that you might like to do is you might like to zoom in on a chart as an example. Now, remembering I don't have my SPA3 investor signals turned on at the moment, so where do I do that? Back on the chart tab, let's turn them on, and there we go. We've got our signals. Now, you might like to zoom in on a chart, and if you want to zoom in, then a simple way to do that is left click on the background of the chart, drag to the right, and that will zoom in. Alternatively, if you want to zoom out, it's just the opposite. Left click on the background of the chart, move to the left, and we've zoomed out. All right, so that's a little bit of an overview of Beyond Charts. Just getting around the basics. Again, once we're in a watch list, we can go through each stock by just clicking on the down arrow. Something else that you might like to do periodically is to investigate the signals. So a signal summary. So this gives you an inside look on the signals on each of the stocks. So what it does is it goes through and it takes every entry and every exit signal, and you'll see back from 2014. So why does it go back to 2014? It goes back to 2014 because our period setting over here on our chart is 10 years. Now, if I change that to all data, then all of a sudden you'll see that the signals summary is updating. So it's going through and it's taking signals all the way back from when Aristocrat was first listed. So it's going through there, it's putting together all the trades. So rather than 2014, it's going all the way back to 1996. So a big pool of data there. It's got our entry signal, entry, exit, all the way through. IST, that's one of those price action signals I was talking about. So where do I find that information? Back on the Home tab under the Documents and Getting Started. It's got all the trades. So they're all long trades. There's no shorting of any stocks. And we've got the trade statistics as well. So this gives you a comparison of using Aristocrat with SPA3 Investor over that time frame. How many trades it's had, what the strike rate is, what the average profit is on each trade, what the payoff ratio is. So that's how many times larger the wins are than the losses. The expectancy, which is a function of strike rate and profit ratio. The annualized return, if you were just trading this as a one stock portfolio, compared to the maximum drawdown. That also compares to the maximum drawdown if you were buying and holding Aristocrat. So interesting to compare those two. What's the risk of buying and holding? Sequence of returns risk. So are you comfortable sitting through a 90% drawdown? Obviously not. That's why we use timing. So when we're using timing, we're going to need a higher skill set, mindset, that is. All right, I think I've covered sufficient there for the time being. Let's get underway. Let's close some of these panels and by doing so, giving us a cleaner, larger workspace. So the first thing I'm going to go through now is to create a new portfolio. So very simple process using the portfolio manager. I'm going to go up and click on new portfolio. So I need to give it a name, and I'm just going to call it David Webinar. And the methodology is a SPA3 investor methodology. Now you can choose a SPA3 trader methodology or a self-directed one if you are just using your own methodology as an example. There's a few hints and tips down here as well, telling you how many positions your portfolio could contain. Generally in Australia, it's usually between 6 and 10. In the US, generally somewhere between 7 and 13. So the public portfolios that we run, which are example portfolios in the Australian market, we've got a portfolio that has 9 stocks. And in the US, the public portfolio has 10. Now, some members may choose to have 6 or 7. Some members I know have had even 5. I know some members who've had 12 or even up to 15. It really doesn't matter, and it's a function of your own comfort level. But these are typically the optimum limits, if you like, for better performance. Okay. All right, so it's going to use a equal weighted approach, and that basically just means that your capital is going to be spread evenly over the number of stocks that you happen to choose. So we're going to invest in Australian dollars. And the start date. So the start date, I'm just going to choose a couple of days ago. So let's do it for, let's say, on Monday, beginning of the week, and I'm going to start with a certain amount of capital. Now, as part of the skills acquisition plan we talked about last week, when you're starting a portfolio, it's important that you start a portfolio with an amount of capital that you're going to be comfortable with. So if you ever happen to have a string of losses, which is undoubtedly going to happen, that it's not going to cause you undue stress. So you might come to the market and ready to employ this new strategy that you've learnt, and you might have $500,000. Would you use $500,000 to start a new portfolio off with this new methodology? Probably not. So how much would you start with? Well, in that particular example, I'd think that something maybe like 10% of that capital might be a reasonable amount to start with. That means you've got some skin in the game, so you've got some learning that you can apply to with real funds, but hopefully that's an amount that's not going to cause you, to drop the ball. Okay, so you need to think about that consciously, because you can always add more capital as you're proceeding and your skills are developing. So in this particular example, let's use that as a starting our portfolio. So we'll type in $50,000. It's our starting capital that's going into the portfolio. Now, in the background, what's happening is that the portfolio manager is actually setting up a mirrored trade account from which the funds are going to be drawn. Okay. Now, in your own real world situation, you're going to have a brokerage account in which this money is going to reside. So the next tab that we need to click on here, prior to that, if we wanted to make a note, we could say initial capital injection if we wanted to. Put that in as a note, and then we can move over to the money management side of things. So we're using SPA3 Investor, so it already knows that we're using an equal weighted approach. Now, the only thing that we need to think about here in this next window is how many positions we're going to take. So I'm going to choose 10 positions, only because I feel comfortable. 10 into 50 makes it really, really easy. 9 into 50, that's a little bit difficult, a little bit more difficult mathematically, but I don't really have to worry about that in any case, because the portfolio manager is going to do the sums for me. But I just like the sound of 10 into 50. The position sizing is based on the open profit at risk. So that just means that when it's calculating position sizes, it's going to consider some of that open trade profit that you have in your portfolio. Now, at some point, you may need to make a little bit of adjustment to the position sizing, because obviously we can't use profit in open positions because it's already allocated to the market, isn't it? So you may get a suggestion where you actually have a trade that might be suggesting $5,200 is your position size, but you might only have $4,900 in available capital. Okay, so you might just need to reduce that so that you can record that particular trade. Okay, we're not using any leverage in this particular portfolio. So the next thing we need to do is click on trading rules. Now, something you might need to alter at some point is this maximum cost percentage. Now, at the moment, the maximum cost percentage is set at 1. So what that means is that if you're placing a a trade and you have a maximum cost percentage of 1%, the portfolio manager is going to give you a message if the value of your brokerage is greater than 1% of the trade. Okay, so as an example there, you'll see in the description, if you've got a position size of $1,000 and you have a brokerage of more than $10, then that's going to be greater than 1% of the maximum cost percentage. So you'll get a little reminder saying, warning, can't place this trade because the maximum cost percentage that you've allocated, that you've set, is not high enough. So if that's the case, you would need to come back in here and edit this setting and change that to maybe 1.5 or 2 as an example. Now that typically is only going to have an impact if you're starting off with a very small account and your brokerage is relatively high by comparison. So hopefully that makes sense there. All right, the other section here, these other 3 boxes you can leave as they are with their default. There's no problems with that. And then the third section there is on brokerage rules. Now, typically, brokerage is going to, for most platforms these days, are tending to go to a fairly flat rate of brokerage. Some will still use a percentage-based model. A Self-Wealth, as an example, uses just a flat $9.50, and a lot of other brokers are going to a flat rate model. If you happen to use one that uses a percentage-based model, then when you're placing trades, you may need to adjust the brokerage. But in this particular instance, if I use a Self-Wealth as an example and put in $9.50, then each time I go to record a new trade, it's going to populate the new trade window with that $9.50. And of course, I can change that at that level as well. Right, so we'll go save and close. And then what you'll notice over in our Watchlist Explorer, you'll see that I've got a watch list there that says PM. So that means Portfolio Manager. And there's the name of it, David Webinar. All right, so I've got a portfolio that's already been set up, just gone through the basic process of doing that. And so the next thing for me to do now is to run a scan. All right, so remembering that our scans, etc., can be run from our Systems tab. So if I click on our Systems tab and I'm running a stocks-based portfolio, so therefore I'm going to run a SPA3 ASX stocks scan, and I click on Start Scan, and it's going to start going through that list. So what I'm looking for here is the presence of any new trades. So it's going through there. You can see it's produced the output there. It's got the signal date, it's got the signal names, and it's got our trade date. Now, our trade date is the date on which we're going to take some action. So I've got a brand new portfolio. The trade date is the 21st, so I can actually go through on the 21st and place a trade. Today happens to be the 21st. So in order to choose which of these stocks I'm going to place in my portfolio, given that I've got 10 positions to fill, I've got 2 opportunities. So I've got one on Perseus Mining and one on Transurban. Now, in this particular instance, because I've got 10 positions to fill, I'll actually take both those positions. However, if I only had the 1 position to fill, then I would default to the one with the highest ranking. Now, the ranking is simply a measure of sort of medium-term momentum. It's actually the change in price over the last 89 days. So as an example, our PRU has changed in price over the last 89 days by 13.16%, whereas TCL has changed in price by only 1.82. Now that's over the last 89 days. It doesn't actually tell me what the change in price has been over the last, say, 21 days or the last 1 week. Okay, so we're just using this as a simple black and white objective way to choose one candidate over the other. Now, it might happen along the way that you happen to have a number of stocks with buys against them, but the ranking might be negative. So as an example, we've got one there on Northern Star where the ranking is minus 7.5. So hypothetically, let's just say we had one that had a ranking of minus 7.5, and all the other opportunities were also negative rankings. Well, if negative 7.5 was the least negative, then that would be the first one that would go into the portfolio. That would go ahead of a candidate that had a ranking of minus 10.5, and that would go in ahead of one that had a ranking of minus 15.5, and so on and so forth. So you're looking for the highest positive ranking or the least negative, okay, in terms of priority. All right, so we need to think about placing a trade, recording a trade. So to do that, I simply right-click and choose trade. Now it's going to open up a new window. So what I first of all need to check is to make sure that the portfolio that I'm going to put this particular trade in is the right one. And it is. It's David Webinar. Okay, so this is important. Now remembering that it's got 10 positions to fill, it's going to try and keep the position as close as possible to a $5,000 level. Okay, so it's telling me at the moment, it's put in the stock code, it's already put in the signal, it's calculated the quantity on the basis of yesterday's close. So as part of this, and you're just about ready to place your trade, there's a couple of different ways that you can do this. I typically write down the suggested quantity. So in this particular example, 1937. Now that's suggested at that price of $2.58. Now you might go into the market today and find out that PRU is trading at $2.55. So you might be able to purchase a few extra to take it to that $5,000 level. You might find that PRU is trading at $2.68. as an example, and so therefore need to reduce the quantity to keep it to that $5,000 level. Okay, so I think most people are pretty comfortable with that idea of either just sort of winding up a few extra shares or winding down just based on what the current price is. Okay, so we're trying to keep it as even as possible. All right, so if we've done that and we're happy to record the trade, keeping in mind that you can always come back later on and edit this trade record. Okay, so don't feel as though once you've clicked save that that's it, you're doomed and you can't correct it. You can certainly come back and change that record. I'll show you how to do that in a moment. So we choose operation successful. Now, one of the things in terms of setting up this new portfolio, which didn't come through, and I might just go through and have a bit of a look, was the 25 trades journaling. So if we go up to our portfolio manager, let's go and have a look at that portfolio and edit. And I haven't got my 25 trades tick box. So normally down here, there's a 25 trades tick box. So when you go to create that new trade record and save that, what you'll find is that a journal entry comes up. All right, so again, given that this is a slightly different version of the version that you've got on your computers at home, a trade journal will come up saying, okay, what are you thinking, saying, feeling, and doing? So as an example, if I go, what we might do is, let's do it this way, see if we can go into our trade records. There it is there. There's our PRU. So this is under trade record. So this is where you can come in and edit a trade record. So highlighting it, if I wanted to come in as an example and change the price, I could do that. I could make it 36, and you'll see the figure down the bottom changing. So I could do that, but importantly, under the journal here, what am I thinking, saying, feeling, and doing? Because ideally this will come up when you create your brand new portfolio, and this is really important. So at this point in time, when you're new to the market, you're new to this system of investing, what are some of the thoughts that you might be thinking at this particular point in time? Starting off with a brand new portfolio, what's something you could be thinking? How about this? Excitement, looking forward to using Investor for my, it could be as simple as that, apart from the spelling error there. So looking forward to using SPA3 Investor for my self-managed super fund. Could be that. Perhaps it is, what else could it be? What other sorts of things might you be thinking as you're about to place this trade? Have you taken any notice of anything in the news, as an example? You listen to Alan Kohler? I don't know why, but maybe it's something that you did. Have you subscribed to a newsletter, compared to a newsletter, as an example? Why you would be doing this, I don't know, but you might be. So just trying to collect some thoughts. Are you perhaps wary of geopolitical news? Whatever it might be, anything that you're thinking at this particular point in time. And the reason for doing this are many. What we want to do is we want to create an awareness of what you are currently thinking, okay? Because it's having an awareness of your current thoughts allows us to identify whether or not we need to make some tweaks, okay? Are there any biases that you may now become aware of? As an example, had success with PRU last time. Might that not be a bias that comes into your mind over a series of trades? The last trade you had on PRU may have been a successful one. So therefore you might be feeling X. Are you feeling more optimistic? Maybe the last trade you had on PRU was a loser. Are you feeling less optimistic? Why are you having these feelings? Either being optimistic or pessimistic, or perhaps you don't have any so-called feeling about this particular stock. So these are all emotions, they are beliefs, they are biases, they are indications of the way that we are currently thinking. And if we can capture those over a series of trades, then we can start to look at them and see whether they are supportive of our efforts or detrimental to our efforts. Okay, so part of this, as we go through it, is we want to empower positive thoughts and we want to de-energize negative thoughts. So this is part of the 25 trades exercise. It doesn't need to be 25 trades. Well, that's going to depend entirely upon the market environment and your experiences in that market environment when you're trading. So we say 25 trades. Mark Douglas, who wrote Trading in the Zone, had a 20 trades exercise. Now, the purposes of this 25 trades is that it's basically going to take at least 12 months for you to go through that 25 trades. Now, does that mean after I've done 25 trades that I don't need to do this exercise anymore? Well, that really depends. And it's going to depend, as I mentioned, on the backdrop. Because if you've done a 25 trades exercise and the market is very gentle and kind, then that's like learning to sail on a pond, okay? Are you going to be able to sail not in that pond, but in an ocean environment where the conditions can change very quickly? And we've seen that in the last few weeks, haven't we, in the markets, how quickly the market can change. So if you've done 25 trades in a calm mill pond type of environment, how much has your trading mindset, those trading skills actually been tested? Remembering that smooth seas never made a competent sailor. So you might find that even though you've done 25 trades, your actual level of skills development and how do we map and monitor that skills development may not have even been tested sufficiently yet. So it's not really a 25 trades exercise. Think about your skills acquisition plan. Have you traded through multiple 10% plus periods of drawdown? Because if you haven't, I'd strongly suggest that you haven't yet been challenged sufficiently. Okay. Now, if you have traded through multiple 10, 15% drawdowns and come through the other side relatively unscathed, with your mindset intact, you haven't dropped the ball, you haven't taken yourself out of the flow of the market, you haven't stopped and sat on the sidelines for any particular reason, then that's showing clear development of skills. If you're going through your journal of trades and you are being honest with yourself and seeing that through those choppy times that you are citing and recording thoughts such as no thought whatsoever, as an example, feeling very settled, calm, disciplined, methodical, patient, it's just another trade, thinking long term, thinking with a very neutral mindset, then that's going to show that you've developed along the way. Particularly useful if you start off reflecting on those with the first few trades you've made where it says optimistic, looking forward to this, and then a few trades later on, oh dear, had a losing trade. Oh, that was no good. Well, what does no good mean? You're putting a value on a trade outcome. So we need to think longer than that. We need to think about the process, not so much about the outcome. So it's these nuances that this particular exercise is very good at capturing. Okay, so it's an important part of your development as an investor, as a trader, and as somebody looking to develop the best mindset possible. Okay. So some of those thoughts, etc. If you're wanting to learn more about that, then obviously the 4-week process and mindset intensive is very, very useful for that. Some of the other things that you might like to record in the journal, the 5 fundamental truths of trading. Now, if you don't know what they are, that just means you haven't been to the 4-week intensive yet. You haven't completed that section. I go through the 5 fundamental truths every Monday morning in the weekly wrap. And the purpose for that is just to model the behavior, the thought process that you all need to go through when you're recording and placing trades. Anything can happen in the market. You don't need to know what's going to happen in order to make money. There's a random distribution between wins and losses for any set of variables that defines an edge. An edge is nothing more than an indication of a higher probability of one thing over another. And the last one, every moment in the market is unique. You could use any of those as your journal entry. And each time you do that, you are reinforcing those positive beliefs, those positive behaviors. All right, so I'm going to save that now. So that's been saved. That's all recorded. We've gone through, we've had a quick look at how to edit a trade record. We've still got one other trade to pop in there, TCL. So let's do that one. So right click again, trade. There's our entry. I'm going to pop in my journal comment while I think of it. Now, keep in mind that when you're doing this, your 25 trades exercise should already have been set up. So you'll actually be presented with a little reminder. David, don't forget to put in your journal entry. All right, well, anything can happen. I'll pop that in there with a smiley face for the time being that I've actually remembered what the first fundamental truth is. Anything can happen. And I'm feeling calm and relaxed, as an example. Collecting your thoughts along the way, okay? And the purpose of this is to create that level of self-awareness. All right. So I'm happy with the quantity. The price that I'm about to place, 13.42, is all fine. I'll save that. So once again, you've gone into the market, you've placed that particular trade, and you might find that your trade record that you got from your broker, the confirmation might be slightly different. So again, if you do need to go and change that particular record, then we just do that through the trade records section. So trade records, TCL, there it is. It's highlighted. I can either right click and choose edit, or I can go up to the top here with the spanner. Does exactly the same thing. Reopens the ticket. There's my journal entry. If I need to change anything, then I can do so. All right. So that's the basics. So far we've gone through creating a new portfolio. We've populated it with the number of stocks we've chosen, the amount of capital. We've gone through, we've run a scan, we've recorded a trade entry. We've recorded our journaling comments, so part of the 25 trades exercise. We've edited any trade records in case we need to thereafter. So what the next thing that we might do is go through and have a look at the public portfolios. The reason for introducing the public portfolios today is to give you a little bit of a benchmark, something to strive towards if you like. So it's a history of real life trades in the market with real capital. Okay, so it's a real life warts and all journey. So you can download the public portfolios, any of the public portfolios that you have a data subscription to. So as an example, we can go under the portfolio managers, down to import, and if you have US data, you'll be able to download the US public portfolios. If you only have the ASX, you'll only be able to download the ASX one. So as part of that, you just need to select the one that you want to highlight and then choose import public portfolio. That will draw the public portfolio down into your version of Beyond Charts, and then you'll be able to see it. So I've already done that a little bit earlier. So from that point of view, I can go through and have a look at the positions that are currently in that portfolio. So I've just clicked on positions here, and this is telling me what's in my current portfolio. If I want to go through and have a look at the public portfolio, I can go down and select that. I've just renamed it DM, ASX Equal Weighted Stocks Portfolio. So this is the public portfolio. I've just renamed it, and we can see the list of candidates that are currently in there. We can see the net profit in each of those positions. Now, if I wanted to go through and see the entire history of the public portfolio, I can do that by clicking on close. So that will show me all the closed trades. If I want to see them both, I can click on both and that'll show both existing open ones and closed ones all together. Right, so that's having a look at the public portfolio positions. Now, some of the other things I might like to look at from the public portfolio for comparative purposes is how statistically that portfolio is going. So to do that, we go up to the values screen. So it'll just open up another tab here with the pie chart on it, and it gives us a portfolio overview. So it's telling us we've got 0 vacant positions, 9 positions are currently being filled. We've got a little bit of cash on the sidelines, and so therefore we're nearly 100% invested. Taking a deeper look at the statistics, it gives us a much bigger picture. So it's showing us what the annualized return is compared to the benchmark, so the index in this particular case. Now, these little eyes down here, that if you hold the cursor over there, it will tell you exactly what each one, or a definition of each one of these selections is. It says we started with $80,000. Along the way, it's telling us what the average profit is per trade, the average exposure over that time frame, what the win rate, so the strike rate is, and what the payoff ratio is as well. It tells us what our maximum drawdown is compared to the market maximum drawdown. It tells us the average hold days for winners is 120 days. It shows that our losers are a lot less at 40 as an example. So it's a good collection, if you like, a dashboard of all the portfolio's history. Okay, so that's in table format. Another way that we can look at public portfolios and your own portfolio that you are procuring over a period of time is to chart it. And we can do that under chart portfolio. So once again, if you have a number of portfolios, you can select them accordingly. So this is the public portfolio there, and you can see what the journey looks like. Okay, so you'll see periods where the portfolio moves up, where it moves down, up and down, sideways, strongly up, down a little bit, up, down, sideways. How does that compare with the broader market? So we can do what's called a benchmark, and that's done using our indicator panel. So I'm just going to pop out our indicator panel, and what we need to do here is just called a base reference. So there's our base reference. I'm just going to put on the details. So down the bottom here under the base reference, we need to choose a starting point. That's our reference date. So this is actually the start date of the public portfolio. And we need to put in the reference. So the reference here is $XAOA. So that's the All Ordinaries Accumulation Index, or alternatively, you can also do a $XJOA, which is the ASX 200 Accumulation Index. All right, they're very similar. We'll use the XJO in this case, and then if I can scroll down, it's going to plot it as a red color against the public portfolio. So I'll just apply it by using the tick, and there we can see the journey of one over the other. So just thinking about this right through the middle here, because it sticks out very, very clearly, this is sequence of returns risk. So when does that happen in your investing lifespan, and how long does it take for the market to recover? Now, we all know that this was COVID and the market came back fairly quickly. However, often is the case that deep, long bear markets can take a long time to come back. So that's why we use timing to try and reduce that sequence of returns risk, but also at the same time, give us rules and very simple processes for being exposed to the market. All right, so that's a bit of a look at beyond charts and a few hints and tips. Now, one of the other things I said I was going to also show was how to add further capital to your portfolio. So if I want to add further capital to my portfolio, then that's done under the cash section. So a few little subsections here. The portfolio, when you're creating new portfolios or importing or wanting to look at the values or charts, a section for trade records, a section for cash records, and a section for dividends. So keeping in mind, when we're using SPA3 Investor, we don't automatically reinvest dividends, so we don't use dividend reinvestment plans. If we do happen to get dividends, we take them as cash. The cash goes into the portfolio and gets recirculated through. Okay, and the reason why we don't use dividend reinvestment plans is because we're using timing. We don't know that that stock is not going to be in a closed position and therefore shouldn't be in it at some date when you might be getting a dividend being reinvested. Okay, so we don't want to reinvest from a automatic reinvestment dividend perspective. We want to take the dividends if we get them as cash and recycle them through the portfolio. So we want a new cash transaction. Let's say that it is now 18 months down the track. I've traded through multiple 10% plus drawdown periods and come through it unscathed. I've learned a lot. My mindset's in the right place. It's actually taken me 45 trades to get through those two periods of drawdown. I'm now at all-time highs. So I'm thinking, right, I'm going to inject some more capital. So all I need to do under the cash transaction, you'll notice that there are different categories here. So capital transfer, withdrawal. So withdrawal, for example, if you're going to take some cash out of your portfolio for some particular reason. So we need to know how to do that as well. So in this case, it's just a capital injection. Today's date, let's put it in there, and we'll put in the amount of $25,000. I'm going to add to it and then save. So that's going to add to my capital. So I started off with the $50,000, and now there's an extra $25,000 in there. So if I do that and go back to my value screen up the top and choose, I think I've just, guess what I've done? I've injected the capital into the wrong portfolio. So let's go back and have a look. Let's go back and have a look at that cash records. There's a capital injection. It was in the wrong portfolio. So what do? Good practice. There it is. Right click. I can choose and delete, or I can go up to the top here and delete. Either one, doesn't matter. Let's do that. Let's clear that up. Let's put the capital in the correct portfolio. A new transaction. I wonder how many of you were sitting there thinking, David, you've put that in the wrong portfolio. Okay, so there's the portfolio. David, webinar, capital injection. Let's put it in. There we go. And save. All right, so let's go through now. Have a look. There we go. Our extra $25,000, keeping in mind that we invested some of the original into those two stocks. So we've added capital to the portfolio. All right. Just looking at the time, we've gone through a fair amount here. So what we might do now is just pop back, close that. Oh, save that one, rather. That was our trade record for TCL. All right. So the only other thing I was going to do was show you was syncing of the portfolio to the app. So I might bring that up again just to cover that, clear a little bit of space on here because it is something that I think is very worthwhile doing. So if we go to our portfolios menu here, you'll see that I've got the portfolios listed. So when you're wanting to synchronize your portfolios to the app, the first thing that we need to do is establish a line of communication with the app. So the way that we do that is by going into our portfolio section and clicking on alerts and PM. Now what it's going to do is come up with this window, and you'll need to pop in your email address and the password. Okay, now typically the password is going to be the app password in the first instance. But if you happen to change your app password, you will also need to come in here and make sure that you change the password accordingly. Otherwise, the two are not going to talk to each other. Okay, so if you've changed the password in the app, please come back here and make sure you change it here. Otherwise, you'll lose that link. Okay. Now, once you've done this, then what you will see is it will list your portfolios ready for syncing. Okay. Now, this particular the setup here with Beyond Charts. On the studio computer that we're using at home is a little bit different to what mine is set up and what yours will be set up. When you do this and you click on login, it'll establish the link and we'll start talking. Okay. Now I don't have the correct email address for using for syncing to the app, so you'll just have to imagine for a moment that I've clicked login and it says yes, login successful. Your portfolios here will appear below, so you'll have two portfolios. So for a moment, just imagine both these portfolios appearing here, and then all you need to do is click on sync with app, there'll be a little box, tick and tick. And then what will happen in the background is that you will see a little green confirmation box, and those portfolios will now appear in the app. And you'll be able to go to the, open up the app, go to the portfolio section, and you'll see your portfolio sitting there. Okay, so that's a good little way of having a reminder that you've got a portfolio, and when the alerts come through at night time, a reminder that you may need to do something. All right, so we've gone through most of those sections there, some basic navigation, the portfolio manager, new portfolio, 25 trades exercise, why it's so important, syncing to the app, looking at the public portfolios and statistics, and learning as much as we can from those. All right, so that was Beyond Charts. So what are 5 actionable strategies that you can employ right now? All right, the first one is accepting uncertainty. So these are mindset strategies. These are skills that we're trying to develop, okay, through the 25 trades exercise, through the 4-week process and mindset intensive. Traders must embrace the market's inherent uncertainty. When you genuinely accept the risk, you'll be at peace with any outcome. This acceptance allows traders to open themselves up to training themselves. So can you see how by using the 25 trades exercise, the 4-week process mindset intensive, that we're trying to get you to the point where you start to understand uncertainty, embrace it, and accept it, accepting the risk. Now, remember I started off at the beginning saying, look, you might have $500,000 to use with the methodology. Let's cut that down so that we can genuinely accept the risks and be at peace with any outcome. We use 10% of that, $50,000. So hopefully you can see that by doing that and allowing you to truly accept the risks in all market conditions, that over a period of time, going through the skills acquisition plan, trading through multiple periods of 10, 15% drawdown, coming out the other side, that will allow you to develop those skills with an amount of capital that's going to allow you to do that. Think how much effort it would require if you were going to do that with $500,000. Would you genuinely accept the risks and be at peace with any outcome? So it's important to accept uncertainty and do it at a level that allows you to sleep at night. So that's number 1. Number 2, probabilistic thinking, trading in the zone, emphasizes that trading is a probability game rather than a game of certainties. Traders should focus on the overall probability of success across multiple trades rather than the outcome of any single trade. So when you are filling in the journal along the way, the 25 trades exercise, be conscious of what you are writing down. Are you focusing on that individual trade, or is it just one of a big selection, a big sample size of trades, which is what you need to create? Think about a casino. If a casino only focused on one outcome, they'd be out of business. They focus on multiple, many hundreds of thousands, millions of outcomes, and they have a very small edge, but they have an edge in their favor. Okay, so that's how we need to think, probabilistic thinking. Developing a disciplined mindset. If you've been somebody who's struggled with discipline in your life, this is now the opportunity for you to start working on that. So consistency in trading comes from the mind, not from the markets. So the consistency you need to seek is in your mind, and therefore not in the markets. This involves developing and sticking to a skills acquisition plan. So if you haven't done your skills acquisition plan, perhaps go back and visit last week's webinar, watch through that, watch session 4 in the 4-week mindset and process intensive, and make sure you get that completed. Very important document. Okay. The next one, focus on process over outcome. So something from James Clear in particular. Focus on executing your trading strategy correctly rather than fixating on profits or losses. Okay, process over outcome. Good results naturally flow from a sound process. The next one, self-awareness and continual improvement. So what's a self-awareness exercise? The 25 trades. Both Mark Douglas and James Clear zoom in on the importance of understanding your own psychological tendencies and biases. So you're going to come to this particular methodology with some of your own tendencies and biases, some of your own baggage. Now, some of it may be supportive, some of it may be detrimental. Becoming aware of that and seeking continual improvement is going to mean that you're going to adjust the mindset and acquire the appropriate skills. So ongoing self-reflection, improvement of one's mental skills is essential to longevity in any worthwhile pursuit. Right, so the 25 trades, at its heart, it's an exercise in self-awareness. It's a skills development tool, and it's integrated into the portfolio manager deliberately as part of it to help enforce consistency and discipline and probabilistic thinking. Now, if you've read Mark Douglas's book, don't forget you can also get that on audio as well. You'll understand that. And as you go through that, I'm hoping that you'll be able to recite the 5 fundamental truths of trading. Have you gone through and traded through in and out of multiple 10+% periods of drawdown? That's part of the objective of the skills acquisition plan, getting to that level of skill set. How many trades? 25, 35, 55, 105, however long it takes for you to achieve those particular objectives. So please don't think of the 25 trades as an exercise isolated completely from the skills acquisition plan. It is integral to the skills acquisition plan. Okay. All right. Success in trading requires more than just knowledge. It demands a time-tested practice and coaching routine. So hopefully you can see that we are endeavouring to get you to practice and be coached throughout the use of SPA3 Investor, making sure that you are engaging along the way. No skill is learned without consistent practice and repeated execution of doing the right thing. The disciplined approach is essential to becoming a consistently peaceful and profitable trader in the long term. A disciplined approach. Thank you for listening. Got some questions from Wayne. David, when the market goes high risk, how do you know or how much of your portfolio should you sell? So Wayne, that's a question that's whose focus is on SPA3 Trader. So SPA3 Investor doesn't use market risk at its heart. So with SPA3 Trader, and this is a really good question. When you're setting up your risk profiles, there are 2 that you can choose from. So risk profile 1 basically stipulates that when we go to high market risk, we're not going to take any further trades. Okay, so we just monitor any of the existing open positions. If there are any sell signals that come along the way, then we close those accordingly, but we don't take any new trades. However, if you're using what's called risk profile 2, you can continue to trade through high market risk, but you need to cut back the position size by 50%. Okay, so if you're placing a trade and the portfolio suggests, oh look, to take a $3,000 position, then you would cut that back and you would only take a $1,500 position. And also, whilst you're in that particular high-risk market, you're also wanting to make sure that your portfolio isn't greater than 50% invested if you're going to continue taking trades. So the idea with risk profile 2 for trader is that you've still got a foot in the market, looking to benefit from those stocks that are holding up and that may continue to either hold up your portfolio or actually even increase your equity during those particular conditions. Wayne said, so how much of your portfolio should you sell? So with trader, you wouldn't sell any portion. All you're doing is you're selling as the signals come through. So hopefully that makes sense. If you need any further discussion about that, Wayne, please feel free to give us a call. I'm more than happy to broaden that chat out for you. Mark says, hi David, is there any benchmarking for SPA3 Trader? Yeah, so with SPA3 Trader, you can import the public portfolio. If you have Trader yourself, you can import that public portfolio, and that also is benchmarked either against the All Ordinaries accumulation or the XJO, the ASX 200 accumulation index. So either of those you can benchmark, and if you've got, you can actually benchmark public portfolios against each other. So you can benchmark a trader portfolio against a SPA3 investor portfolio. You can benchmark, if you've got the right data supply, that is, you can benchmark a ASX SPA3 investor portfolio against a USA SPA3 investor portfolio as well, and against their respective benchmarks, all on the one chart. So you can have lines going everywhere, but that's very useful for understanding the story, the ebb and flow of the markets and the ebb and flow of the systems as well, particularly under extreme market conditions. You can learn a lot from that. So good questions. Oh, Wayne, you've been very nice. Thank you. Again, the purpose of these webinars is to try and remind you of the context in which we are investing and to establish some building blocks. So you've got the context, you understand the skills acquisition plan, very important document. It's central to the 4-week process and mindset intensive. So we're really trying to provide you with as much nurturing to help you develop the mindset skills, because the mindset skills are the things that the vast majority of investors put no time and effort into, and they take a perfectly good system and they end up not getting anywhere close to the performance that they should. And that's regardless of whatever methodology they happen to use, whether it's one of ours, whether it's one of your own or somebody else's. So the mindset is really, really important. It's just like driving a car. You know the rules, the basic processes, but you're only going to get to your destination safely if you manage and allow yourself to travel through different road conditions with the appropriate mindset, and that's what it's all about. So thank you for joining us today. I hope you've got some benefit out of it, and we'll catch up with you with the next one. Enjoy your week. Bye for now.